we've got an optimistic view of prices in the longer term, and perhaps as sentiment towards the global economy starts to improve, and especially to China leading the way in the fourth quarter, then maybe we'll see some of those fund flows coming back into commodities before the year end or early next year. Cool. Thank you very much to One-to-One Group for inviting me to speak today. I'm going to talk about the outlook for the metals prices into the year end, which I think is actually, I might be a bit more on the positive side versus a lot of the consensus expectations, because I do see China actually starting to recover on its general economy and especially metals demand, construction activity into the fourth quarter. So it's been a tough couple of months for metals prices generally. Obviously, a lot of global economic headwinds, a lot of concerns about the impacts of higher energy costs globally and weaker economic growth, inflation effects, etc. And of course, China itself has been doing very poorly this year. The Chinese economy particularly disrupted by COVID lockdowns. It seems to be every week we have a different city, a different province impacted by that. That's brought a lot of uncertainty to the economic operating environment within China. And on top of that, they've had a very slow housing market, which is a result of 2 years of quite tight housing policies in China, especially focused on the developers, which has now caused the activity to drop perhaps a bit too much for Beijing's comfort. On top of that, with the general economic weakness in China, you're seeing rising unemployment levels, weak consumer spending. So that just added more headwinds to the economy that we've seen through the second quarter and third quarter. However, Beijing has noticed that things have been deteriorating too sharply, and they have been responding to that. So we've heard talk of China stimulating the economy since the end of last year, really. But initially, the first few months, it was about alleviating a harder downturn. It wasn't really full-on stimulus. It wasn't about trying to accelerate the economy. But I think since May, the tone out of Beijing has become increasingly desperate, increasingly concerned about that economic weakness. And now I believe they have actually done enough on that policy loosening that we will see a sequential improvement in the economy into the fourth quarter. So I think construction activity will be bottoming out, general economic conditions will be improving, and that's normally very good for metals prices, of course. So a couple of key lead indicators, of course, are credit conditions. That's generally, if Beijing's tightening the economy, they're making credit conditions much tougher, trying to reduce the amount of money that's circulating. And equally, when they're trying to support growth, then Beijing's generally increasing the amount of money in the economy. Now, given the economic weakness, given the COVID uncertainties, corporates are not feeling too optimistic. So the private sector has not really been investing very strongly this year. The credit demand from the private sector and from consumers remains quite weak. So the stimulus that we're seeing, of course, is very much government-focused spending. The extra special bond issuance, focus on infrastructure spending, and now the support that the government is offering to property developers to try and get the property market re-accelerating. So we've certainly seen an improvement in credit conditions overall. It's certainly been very reliant on that government spending, but the improvement is very visible in recent months. And there's a clear correlation here between those improving credit conditions and general economic conditions. So that certainly leads to support the view that the economy should be improving from the fourth quarter. Of course, central to this recovery will be the construction markets in China. Now, Beijing's been going through a journey on the property developer side of things for the last couple of years. Policies we've heard, such as the 3 red lines policy, which has been trying to restrict developers' access to credit, trying to get them to repair their balance sheets, speculate less with land banks, and generally behave in a more responsible manner, which reduces the financial risks to the banks and also creates a property market which can match with real demand. So the property market in China, they've been building about 14 to 15 million units a year in recent years, but around a third of sales prior to 2020 were going to second home buyers, what Beijing classifies as speculators. If we look back over the last 20 years, China has in fact built over 250 million apartments. That's essentially one for every registered urban family. That's incredible pace of construction and not really sustainable especially when you look at China's demographic profile. So the overarching goal of China's property reforms in the last couple of years has been to deleverage the developers and shrink the size of the property market and restrict the access to speculators, make sure that housing, as she says, housing is for living, not for investing. So they really want to make sure that the housing market is only building what there is real demand for, and that would imply about 8 to 9 million units a year versus that 14 million run rate. So last year, the property construction activity shrunk by about 12%. That seemed manageable from Beijing's perspective. It was not harming the economy, slowing property at that kind of trajectory. But since mid-year, that property activity has really slowed too sharply for comfort. We're seeing a 48% drop in construction activity year on year in June and July, and that has just been causing too much concern. Of course, there have also been a lot of headlines about consumers in China withholding mortgage payments, developers who've suspended projects, and basically the developers' finances have just been squeezed too far. So Beijing is not reversing course on the structural goals of this policy, but what they don't want is to have a skyline littered with unfinished apartments. So general estimates seem to be around 8 to 12% of construction projects currently suspended in China, but Beijing has in recent weeks been offering credit guarantees or taking over some of the weaker developers with SOE construction companies just to get these projects finished. So that's where I think a lot of the construction reacceleration can come from in the fourth quarter. That we should see it bottoming out in all the housing data and the construction data. And don't forget seasonality as well. For the fourth quarter, you tend to have strong construction seasons in China. In the second quarter, post-Chinese New Year, ramping up into springtime, then you generally see a construction lull through the summer, and then a stronger again September through November into winter. So I think we will get seasonal reacceleration in construction. On top of that, we will get the housing developers restarting suspended projects. And on top of that, we'll get more flow through from infrastructure spending as well. So you put all that together, and I think the Chinese economy should see a decent recovery in the fourth quarter, but a very construction-focused recovery. Also remember last year, it was around September last year, the Chinese economy really started to slow on the back of the power shortages. So we'll also have much easier base effect for a lot of the data in the fourth quarter, which will help to perhaps turn sentiment more aggressively. At the moment, sentiment's extremely bearish towards China and to global growth, but we could see that situation for China reversing quite sharply in the fourth quarter as the data starts to improve. So what does this all mean for metals prices? Base metals prices especially have seen a lot of volatility in recent months. Liquidity concerns, liquidity has been quite low. We've seen a lot of shorting activity coming in on the back of those global macro concerns, but then we've seen a lot of short covering recently as well. We've got quite low inventory across a lot of the metals, things like SHFE, copper inventories or zinc inventories on the LME at very low levels. That's encouraged short squeezes and quite rapid price recoveries there. Aluminium as well is one which stands out as having very low inventory now on the LME, below 300,000 tons, down from over 2 million tons early last year. But so far, aluminium hasn't seen as much of a short squeeze as copper and zinc, but that's certainly a risk as we go into the fourth quarter and potentially see aluminium production cuts increasing out of Europe, out of the US, maybe out of China as well, given the way that the hydropower situation has been deteriorating. So fund flows into commodities have also been reversing recently. We saw a lot of fund flows increasing into commodities since 2020. But since June, with the global growth concerns, a lot of that money has come out of the space. Of course, we still have a lot of structural long-term stories for the commodities, things like copper with the green energy revolution, EV story. Copper's very exposed to that. And aluminium, stories like the China capacity cap or global carbon pricing. There's a lot of structural stories there, which mean we've got an optimistic view of prices in the longer term. And perhaps as sentiment towards the global economy starts to improve, and especially to China leading the way in the fourth quarter, then maybe we'll see some of those fund flows coming back into commodities before the year end or early next year. So I see aluminium and alumina as best supportive of the base metals here. I think aluminium production globally will slow quite rapidly from here for the rest of the year. We've seen strong growth from China in the first half of the year, especially on the back of the hydro power, which is up 20% year on year in the first half of the year. But China now experiencing power shortages again, plus aluminium prices starting to move into the cost curve. That's going to slow that Chinese production acceleration. And outside China, of course, we're still looking at more production cuts, especially as energy costs remain very high in Europe and elsewhere. Steel and steel-related raw materials as well should do very well in the fourth quarter, given the recovery I'm expecting. China will be very construction-centric. It's going to be about housing. It's going to be about infrastructure. That's going to require a lot of steel and cement. So those kind of commodities should see more attractive pricing in the fourth quarter as well. In terms of the battery materials, technology materials space, my preference has long been for lithium over cobalt and nickel. And I think that very much remains the case, certainly through the rest of this year and probably for the next few years going ahead. So lithium prices remained very resilient during April and May, even though we saw a lot of auto production cuts with the COVID lockdowns on the East Coast. A lot of battery facilities as well paused production activities. But lithium prices, obviously extremely elevated levels, was expecting perhaps to see some weakness with that demand chain disruption, but it never materialized. Through the chain, people were happy to build inventory, given that desperation to secure materials. And since then, lithium is one of the few commodities with a good demand story still in China. In recent months, you've seen the re-acceleration out of the COVID lockdowns in auto production, especially focused on EVs over the traditional ICEs. And again, my preference for lithium over nickel and cobalt really comes from the technology shift that we're seeing in China. China's been massively moving into the LFP space, especially for the smaller, medium-sized vehicles. They've improved the technology good enough now. We have very mild winter, cold weather power draws, decent enough range for those smaller vehicles. So LFP is good enough for that market segment. And you've seen the LFP share of China's battery production move from 30% in 2020 to 50% by the middle of last year, and it's now over 2/3. And that journey that the Chinese auto manufacturers have been on, I think could well be repeated in the West, especially in Europe. So especially given what's happened to nickel prices this year, sourcing issues around Russia, on top of the sourcing issues people were already suffering with cobalt. The European EV space has gone heavily into the NCM technology, but given the Chinese have shown a pathway for that LFP technology improvement for the smaller vehicles, Europe being an auto market dominated more by those smaller vehicles, I think we could well see the European auto manufacturers start to look more and more at LFP as well. So I think that lithium is going to have a much stronger demand trajectory than some of the other battery materials. And at the same time, certainly for this year, the nickel supply does seem very plentiful. Indonesia just continues to add an immense amount of nickel pig iron and MHP, and equally seems to be an abundance of nickel sulfate in China this year. So you've seen quite a bit of weakness in nickel sulfate prices in recent months, which I do expect to continue through the rest of the year. So that's it from me, just a brief overview, and I look forward to speaking to you in future. Thanks.